Hey, what's up, everybody? So today I want to talk about a specific type of company that is very rare, but offers investors the best source for long-term returns. And when I say long-term, I'm talking 10, 20, even 30 or more years. And that is the long-term compounder, or otherwise known as the buy and hold forever type of stock. This is a unique breed of companies, and there's very few companies out there. And even for myself, I'll be honest, most of the companies that I am personally investing in are not necessarily companies that I would hold forever. They are companies that I think are undervalued right now for their own set of unique reasons, but they're not necessarily companies I'd be comfortable holding for 10, 20, 30 years. Because something could happen to these companies in the far future that's far beyond anyone's ability to foresee that could actually threaten these business models. Capitalism is a brutal world, and the nature of the game is that new companies, new business models, and new technologies will all be created in the future that replace the incumbents and raise the productivity of the economy overall, and by extension raise the living standards of citizens. This is why indexes like the S&P 500 have performed so well for over a century now, and it's why the conventional wisdom when it comes to investing is just buy the index and forget about it. Now, personally, I'm all for index investing, even more so than investing into individual companies. But that being said, I do think there are specific companies out there that have a very particular set of qualities that do make them a long-term compounder type of investment. And over the long term, that could lead to better returns than just being invested in a index. The most important quality it needs to have, in my opinion, is there needs to be a moat or some kind of durable competitive advantage. And the reason is that this is really the only thing that can keep a company in business for the long term. And economic moats can take many different forms, and sometimes they aren't always obvious. But as they become stronger, you usually see a company's valuation multiple gradually expand. For example, if we look at Costco's PE ratio over the last 10 plus years, we can see pretty clearly that it has gradually expanded because the moat keeps getting stronger. Their membership base gets bigger, which means they have more customers and more negotiating leverage with their suppliers to secure the best prices, and they can also keep redeploying capital into opening new stores. And this ties into the second quality that I believe long-term compounders must have, which is it needs to have the opportunity to reinvest or redeploy capital at high rates of return for a very long time. There's quite a lot of companies out there that can earn high returns on capital for brief periods of time. For example, there's cyclical industries that go through stages where they hit cyclical highs like oil and gas, steel, fertilizer companies, or just any companies that rely on high commodity prices. There's also companies that can earn high returns on capital for several decades, but eventually see those returns fizzle out due to competition catching up. But ultimately, what we're looking for is does the company have opportunities out there to keep deploying capital? And a great example of this is Constellation Software, which we all now know is a long-term compounder because of the returns that they have historically given. But they've had the exact same strategy of buying mid-sized software companies that serve niche markets for almost 30 years now. They've basically never changed their business model since they were founded. So for them, as long as there's other software companies out there that are being started that they can then eventually purchase, there will always be opportunities to reinvest capital at high rates of return. Now, the third quality is that it needs to have a resilient or recession resistant business model. Now, this doesn't necessarily mean that it has to operate in a recession resistant industry. It's more about how the business is set up. And a great example of this is McDonald's. Fundamentally, they are a restaurant, and restaurants are exposed to changes in consumer spending levels, consumer tastes. But as we all know, McDonald's is primarily a franchise, which means they collect a steady stream of revenue through franchise fees and royalties, and they also own the land where the buildings are located and lease it back to the franchisees. So they're not as exposed to changes in consumer spending levels. And since they figured out how to expand internationally and adapt their menu to local tastes, they can keep on expanding, which for them is how they reinvest and redeploy capital by opening new locations all across the world, which not many restaurants or even retailers have been able to do. And this is important because the number one rule of investing is don't lose money. And the number two rule is don't forget number one. And if you are invested in cyclical companies, they will go through periods of cyclical lows where the returns are low and they don't make very much money, which makes long-term compounding type of gains much harder to achieve. And then the fourth and final quality is that it needs to have a strong management team. And I think this is pretty self-explanatory. The ability for a company to become a long-term compounder depends on their ability to allocate capital, and it's the management team that makes those decisions. So you need to ensure that the management team's incentives are aligned with yours as a shareholder. So the company I'm talking about that is my number one buy and hold forever company is Markel. Now, Markel, I'm sure at least some of you have heard of before. They're often referred to as a mini Berkshire Hathaway because they do apply similar principles as they do, but they are actually different in certain key aspects. For one, they're much smaller than Berkshire Hathaway. Berkshire Hathaway is now a trillion-dollar company with over 270 billion in cash and short-term investments, which is a lot of capital to deploy. They've basically beaten the game of investing and are now just doing little side quests. For example, news recently broke that they had opened a position in Ulta Beauty. And this was a $260 million position, but this is only about 0.1% of their total portfolio. So, sure, it's a vote of confidence for Ulta investors, but really this won't move the needle for them. And this is the problem they face now. There's just only so many good investments out there, and they're just too big now to keep benefiting from them. But Markel doesn't have this problem, right? They're only a $20 billion company, so there's still plenty of investments they can make that will move the needle for them. And similar to Berkshire Hathaway, Markel only initiates share buybacks when they believe the share price is below the intrinsic value. And recently, they've been buying back a lot of shares. Through the first 6 months of 2024, they bought back $260 million worth of shares, which is up from 187 million in 2023, which has reduced their share count by almost 500,000 shares over the past year. But it's not just the size of Markel that makes them unique, it's also the business model. So, for some quick background on Markel, they have three distinct aspects of their business, which are insurance, the equity portfolio, and Markel Ventures. So, insurance is specialty insurance or hard to assess type of risks like environmental risks, cybersecurity risks, event cancellation insurance, and even some strange ones like body part insurance, where, say, if you're a professional athlete or maybe a dancer and you rely on a certain body part for your career, yes, you can get insurance on that, and Markel does offer that. The best metric that you can use to assess insurance operations for any sort of property and casualty insurer is the combined ratio. So this metric measures how good they are at underwriting, or basically deciding who to extend insurance coverage to. The combined ratio is made up of the loss ratio and the expense ratio, and the loss ratio relates to payouts made by the insurance company for claims, and the expense ratio is their direct costs associated with providing that coverage. So admin costs, employee pay, etc. So, for example, if you have a combined ratio of 95%, then you can basically interpret that as for every $1 in premiums they receive, Markel is spending 95 cents on paying out insurance claims and on premium related expenses. So here's what their combined ratio has looked like historically over the past 10 years. It's averaged about 95%, with just 1 year where it went over 100%, which was in 2017. And this metric directly ties into the profit that they report for their insurance segment. So a lower combined ratio means higher insurance profit. This is one of the reasons why Markel's profits overall fluctuate so much year to year, which I think adds to the difficulty in actually assessing the value of this business. Now, Markel's equity portfolio is quite unique from other insurance companies. Normally, what insurance companies do is they invest their float, the float being the money they've collected in premiums for their customers but are not yet obligated to pay out as claims. They invest the float into very low risk investments like treasuries, mortgage backed securities, corporate bonds, and then maybe a small amount in equities, like 3 or 5% of their total portfolio. But Markel's portfolio is roughly 40% in equities, with much less in bonds, but a similar amount in government treasuries overall, which does present some additional risk to Markel. But if we look at what equities they hold, we see a lot of very moody companies, right? So companies like Berkshire Hathaway, which is their largest holding, big tech companies like Google, Amazon, Microsoft, Apple, and even companies like Home Depot that you could argue has a moat as they are the largest home improvement retailer in the world. But as we can see, a very diverse selection of companies. In fact, they own 85 out of the 507 companies that currently make up the S&P 500, and those 85 companies represent about 35% of the S&P 500's total market cap. And the performance of their equity portfolio has historically been very strong. As we can see here, by the end of 2023, they averaged 14.6% annual returns over the prior 5 years, while the S&P 500 returned just over 11% over that same period. And Markel has detailed at a very high level what their process is for selecting investments, whether it's a public company or a private company. And they use a four-step process, which is number one, companies with consistently high returns on capital that don't use much debt to achieve that. Number two is strong management teams. Number three is the business has to have reinvestment opportunities. And number four, it has to be valued at what they think is a fair price. And then lastly, the most interesting aspect of their business is Markel Ventures. So this is basically their private equity business that they run within Markel. And over the years, Markel Ventures has grown considerably. It went from 39 million in operating income in 2014 to 437 million in 2023. So if we apply, say, a 10x multiple to value just this specific part of Markel, we get about 4.3 billion in enterprise value just from Markel Ventures. And if we assume that Markel Ventures keeps growing earnings at, say, 15% a year, which is lower than what it's historically been, then about within 12 years' time, we could get to a point where the value of Markel Ventures alone surpasses what their current market cap is of about 20 billion. So ultimately, what you have with Markel is a company that is buying back shares when the price makes sense to do so. You have a consistently profitable insurance operation, a equity portfolio that has historically outperformed the S&P 500, and a Markel Ventures business which is growing very fast. So now let's go back to those four qualities that I talked about earlier for long-term compounders and see how Markel stacks up. So do they have an economic moat? Yes, they do. And the moat is their management, who's shown that they can consistently earn market-beating returns in public equities and also through owning businesses in Markel Ventures. And personally, I think a strong management team is one of the best moats you can have because it's very obvious that no other company has it. A management team is something that you know for sure is going to be unique to each company. Number two, does it have opportunities to reinvest capital at high rates of return for a very long time? Yes, they do because of their equity portfolio and because of Markel Ventures. They can essentially just keep buying companies as long as they can find companies that meet their investment criteria. Number three, does it have a resilient and recession resistant business model? Generally speaking, it does because they own such a diversified range of businesses, but they are still exposed to insurance specific risks from things like natural disasters, which can cause losses like we saw in 2017. And number four, does it have a strong management team? Yes, I believe that it does. So, with all that in mind, what would be a fair price to invest in Markel at? Well, in my opinion, the price to book value metric is a good one to use. In fact, Markel management is even compensated based on the growth in book value per share over a 5 year period. So it's clear that they believe that book value is an important metric to use to assess this company. And as we can see, the price to book value metric has been very consistent over the years with an average about 1.3x. So generally when it's in the 1.2 to 1.1 range, that's when it's a good time to open a position in Markel because historically speaking, that is when the business is cheap. Now, something that I think keeps investors away from investing in Markel is how the share price has performed over the past decade. It's actually underperformed the market with about 9% annual returns over the past 10 years, whereas the S&P 500 has done about 15% annually over that same time frame. Now, one important consideration is that Markel's beta is below 1. It's currently at about 0.7, 0.8 range. So if you believe that beta is an indication of riskiness for stocks, then Markel's risk-adjusted returns would actually be more like 12, 12.5% per year, which still does underperform the S&P 500. But also consider that since the start of 2022 until the present day, the market overall has offered about 8% annual returns, mainly because of the massive decline in the year 2022, which is about 18% decline for that year. Whereas Markel in that same time frame has done just over 10% a year. So in more recent years, even after AI has supercharged the index to all-time highs with so many other companies struggling, Markel has still outperformed the S&P 500, which goes back to the point I made earlier about having a resilient business model. And also consider that if the Markel Ventures portfolio continues to compound at a high rate of return like it has historically, eventually this will make up a larger and larger share of the business to the point where it's a much more significant driver of future returns. And in Q2 of 2024, Markel Ventures reported 177 million in operating income and actually overtook the insurance segment, which generated 134 million. So those are the reasons why I am personally invested in this company and why I have no plans on selling this investment anytime soon. So I hope you guys did find this video insightful and useful. If you did, then please leave a like and let me know what you think in the comments section below. And I'll see you guys in the next video.